Organized money.
Please like, subscribe, and hit the notification button so that more people can get exposed to organized money. Really appreciate it.
All right, today our episode is about electric utilities and why they charge too much and why they're generally terrible at what they do.
How dare you? PG&E is wonderful, except
except for burning down my state.
Burning down California.
Yeah.
Whatever. Everybody makes a mistake now and then, burns down a state. And also, who in New York doesn't love Con Edison?
Yeah, if you like Sandy and what happened during that, you'll love. I mean, look, everybody beats up on electricity companies, and mostly they beat them up for how they respond to crisis. Con Edison didn't have ladders stocked up in New York before the hurricane. The sparks flying in areas of California with just under scrub brush. Usually we focus on that, but in today's episode we're going to focus on a bit of a different thing, right?
Yeah, so everybody's got a story about their gas or electric utility charging too much money, treating them poorly, and meanwhile these companies, their grids are falling apart, and they say they have to replace it all for electrification, which is going to be super expensive. So we want to answer the question, like, where did all the money go? What's going on?
and amazingly, it's a really simple story. They've just convinced regulators and advocates with fake economic models to let them charge too much money and invest in stupid things. It's unbelievable that it's that simple, but it is.
Right. So how?
Well, that's what we're going to get into. I mean, but it's this small number of economists. It's a small number of models. It's this insular society, and that I use that word very deliberately, that is jacking our electricity rates up.
And everyone is actually afraid in this world of being out of the consensus, right? It's a small group of people. Actually, we're finding it's just two people who run a lot of set pricing for the whole industry. Just two experts. And
yeah,
there's an emperor's new clothes vibe to it, right? So there's just fancy people saying things that are obviously wrong, but these people are so fancy that everyone is scared to call them out.
Yeah, and we have a great guest to talk about this. He's a former utility executive. His name Mark Ellis. He figured out this whole scam, and he's going to tell it to us right now. It's called Organized Money. Mark Ellis, welcome to Organized Money.
Thank you. It's great to be here.
All right, we're going to give your background. Matt affectionately calls this the Jewish mother part of the show. You were the chief of corporate strategy and chief economist at Sempra. You were a consultant at McKinsey & Company, an analyst at ExxonMobil, engineer for SoCal Edison and Sanyo Electric. You have a master's from MIT's Technology and Policy program and a bachelor in science in mechanical engineering from Harvard. You are very impressive, an impressive man. Given that resume, it's interesting that we're having you on Organized Money on this show, because that's about five corporate actors that we sometimes don't talk so highly about. So you currently testify in front of state public utility commissions, and in particular, you wrote this paper about how electric utilities are too profitable. And this is not new. We found a quote from Franklin Roosevelt in 1932 that says, as always, the public, should I try it in Franklin Roosevelt voice? No, I'm not going to do that. As always,
do it in a Jewish mother voice.
is beginning to understand. The public is beginning to understand the need for reform after the same public has been fleeced out of millions of dollars. And I just want to start by asking you, how are we still in the same situation today, almost 100 years later?
That's a tough question. Why are we still in the same situation? There's a lot of different answers because it's not a purely, just look at the numbers. It's an institutional problem, right? So it has to do with the weakness of the regulators and it's a concentrated benefits in sort of dissolved or disparate, widespread costs. And so you have these
Hmm.
concentrated benefits in utility shareholders, and then the costs are spread out over all the customers. And so you just have this this you know,
Got it.
organizing challenge.
We're, I don't want to say that it's, there have been, it's 110 years since that, or no, 90 years, sorry, bad math, but
Jesus.
I know it's terrible. I didn't get a BS in mechanical engineering from Harvard or whatever, so I don't have to, I don't know. But prices. We'll go into history. It hasn't always been this bad. It's just bad now. It's as bad as it was in 1932, and there's been time in between. But
Yeah.
let's start with the basics. Okay, without getting to your theory, how does the electric utility sector in America work? What percentage of utilities are investor owned versus publicly owned? How are utilities divided, like generation versus transmission? Like just sort of like in 30 seconds, utility 101 for our audience.
Okay. So I'll start with ownership. So roughly, maybe one clarification before I begin. It's not just electric utilities, it's also gas. So gas utilities face the same type of regulation and the same type of excess returns. So for electricity, about 70% of the electricity is provided by what are called investor-owned utilities.
Hmm.
And the other 30% is provided by public utilities, typically state and municipal, local. There are some federal utilities as well. And what we're talking about today only applies to the investor-owned utilities. And investor-owned utilities provide 95% of the natural gas in the country. So for investor-owned utilities, they are subject. So the basic principle or the basic idea goes back to Thomas Edison's day, is that utilities were long considered a natural monopoly. In the very early days, you had competing providers like running lines down the same street. And they felt like, hey, that's a safety hazard and it's an inefficient use of capital. Really, each utility should have a dedicated service territory, and we will give them a monopoly franchise. And in exchange for that monopoly franchise, they have a universal obligation to serve. So anybody who wants to connect and is willing to pay the rate, you have to serve them. And you will be subject to what is called cost of service regulation. Cost of service regulation basically is you can charge your actual costs to the customers, no more, no less. No less because we want you to stay in business, but no more just because anything above your actual cost is just you're extracting rent and not providing any incremental value. And that's the basic principle, cost of service regulation.
Basic principle and the basic bargain, kind of, right?
Yeah.
That's like, we're going to give you this market, a monopoly market, but we're going to regulate it pretty tightly. And there's some specific language in that, right? It's about, I remember the term is just and reasonable, right?
Yeah.
And that characterizes the prices. Is that correct?
Yeah. Yeah. So just and reasonable is interpreted to mean, oh, you can recover your costs, your actual costs. Yeah.
Got it.
Not more, not more. If it's more, then it's not just and reasonable because you're not doing anything to earn that excess over your cost.
So you have this paper out with the American Economic Liberties Project, rate of return equals cost of capital. We'll put the paper link in the show notes. And you had this incredible stat in there. Over the last 3 years, rates for investor-owned utilities went up 49% higher than the rate of inflation, whereas rates for publicly owned utilities have gone up 44% less than inflation. That is absolutely remarkable and kind of, I mean, is that normal that the investor owned rates would be rising so quickly relative to public utilities?
No, that's normal, not normal. If you look over long periods of time, the rates of both have tended to track general inflation over, last 20, 30, 40 years. And then more recently, the rates have had this bifurcation in their trajectory. Yeah.
So what's happening, I guess, is the next question. But go ahead, Matt.
Well, so okay, so I want to get to the like essentially the scam that you've written about, you
Yeah.
figured out, which is very cool. You know, I'm a sort of connoisseur of scams.
Yeah.
This one is like, beautiful. But
Chef's
before
kiss.
we get there, let's do some more utilities 101.
Yeah.
How do these prices get set, right? So we talked about just and reasonable, you know, the cost of service business model, but someone's got to set those prices, or, you know, the utilities got to be clearly be involved. But how does it work?
Yeah.
And maybe you could walk us through, actually, yeah, just how do these commissions work?
Yeah. So basically, commissions have two jobs. They approve how much the utility is allowed to spend, and then how much profit they make. So when you think about, okay, how does that affect rates? So basically, however much they spend, they're allowed to recover in rates plus a profit. And the profit is supposed to be just and reasonable. And I'll explain how they define just and reasonable in the context of utility rate making. So if you think about the cost that a utility...
Wait, before we get there, let's just get to the process. So
Yeah.
we're just going through, not the substance, not how it's calculated. We'll get to that. So like, walk us through a rate case. Like the commission says, you know, hey, we want to look at pricing, or does the utility say we want to raise our prices? And like, what happens, right?
Yeah.
What's the role of someone like you?
Yeah, so in a typical rate case, a utility comes in and says, hey, well, we want to increase our rates because our costs have gone up. And sometimes it's at the discretion of the utility. Sometimes it's just every 3 years you come in for a rate case. So when the utility comes in, they say, here's our costs, and the costs fall into two buckets. Basically, you can think of them as operating costs, like fuel, salaries, rent, purchased electricity. And then there's capital costs. So utilities in general are known to be a very capital intensive industry. They invest in long-lived assets like transmission lines and power plants and distribution facilities and distribution lines and so forth. And for the operating costs, the general principle is they're allowed to recover those costs in the year that they're incurred. So salaries, they add them up and they say, okay, whatever you expect your salaries to be over the next year, you sort of divide them by the number of kilowatt hours you plan to, sell in the next year, and that's how much you can recover in rates. But for long-lived assets, they don't allow say, well, you spend $1 billion on a transmission line, go recover $1 billion in rates that year. You have to amortize it over. They say you have to amortize it over the life of the asset, and so they take that asset, and if it's say 20 years, last 20 years, then every year they were for $1 billion, it would be 50 million. They recover in the form of depreciation. So they recover the return of capital. So return of capital is depreciation. And then they say, well, wait a minute, I'm putting money out. The utility says, wait a minute, I'm putting money out up front. Right. And there's a time value of money. I deserve compensation for the time value of money. And we're all we know about interest rates, and we know about when we invest in the stock market, we have an expected return. We don't do it for nothing.
So it's like they're making a loan. That's what you wrote in the paper. It's like the utility's kind of making a loan.
Yeah,
right?
Essentially. Yeah.
And they want their interest basically from the ratepayer on how much time they're using to put it out.
Or else like, why would you, if you're not going to get a return on it, we just put that $1 billion somewhere else, right? Is that kind of the principle? All right. Okay, but then in the process, so they want to get a return on that capital, and they want to get their expenses paid. Yeah. Do other people come into the rate case and say, no, we want lower, or like, how does that, how does it work?
So a rate case, it's a legal proceeding. So it's with a court, and usually there's an administrative law judge who oversees the process, and there's commissioners who approve the final decision. But it is a process where the utility presents their application and their testimony, and then various parties can protest it or provide commentary, either in support of or against the utility's filing. Usually it's in opposition to it. And they typically fall into three categories. So one is there are very common public advocates, either part of the Utilities Commission or either part of the Utilities Commission or part of the Attorney General's office, or sometimes it's just a separate government agency whose job it is to watch out for the consumer interest. And then there are third party, then sometimes there's the regulatory staff also can participate and provide input in that process, provide testimony in that process. And then there are third party, non-utility, non-government entities that can participate in these processes as well. Typically consumer advocates, like third-party consumer advocates, nonprofit consumer advocates, or environmental advocates tend to participate.
Now,
I went through one of these rate cases and I found that Walmart was participating in it. They were a big power buyer and they were saying, hey, Pepco, because I looked at my own, I was like, I'm going to look at my own, utility, which is Pepco. And Walmart was like, no, Pepco is asking for too much. But then also the Government Services Administration, the federal government was participating.
Yeah.
Right.
So there's like a bunch of, but could like anyone participate? Could I just go and be like, hey, I buy power from Pepco. I'd like it lower, or is it really limited?
So Walmart, for example, is a consumer advocate. They are a large consumer, but they're basically a consumer advocate. And then the federal government,
they're just like me.
Yeah, federal agencies, the federal government is the largest purchaser of electricity in the United States. So they are also participating as a consumer advocate just for a particular consumer constituency.
Right. I mean, so that's all very interesting that you have all these different participants with different perspectives. But what you lay out in this paper is that you don't actually need that because there's this basic principle in finance that really should govern how the rates should be set, right? And that is rate of return equals cost of capital, which is the name of the paper as well. So could you explain that concept?
Yeah. So for the rate of return, I would agree that you really don't need all these third parties intervening on the rate of return. On other expenses, Walmart, for example, has a lot to say about rooftop solar because they have a lot of roofs. So but on the rate of return, one of the fallacies that the utilities have propagated that rate of return is more art than science, and it's not. This is very, very old school textbook.
And what do we mean when we say rate of return? What do we mean?
So the rate of return I talked before about, then when they make a capital investment, they get to they recover it over a number of years, and then so there's the return of capital. Then there's the return on capital, which is the time value of money, like the interest rate.
The interest.
So when the utility finances it, they use debt and equity, right? Like many companies, they will use a mix of debt and equity. And there's a longstanding principle that, hey, we want the utility to have a strong credit rating. And so they tend to have very conservative amount of debt. And there's good sort of, from an investor perspective and from a public interest perspective, there's sound reasoning behind that. You don't want these utilities taking on too much debt. And that's a relatively straightforward process to figure out what the appropriate level of debt is. So they issue debt, and then the rate of return or the return on capital for the debt is just the debt interest rate. They go to market or they go to a bank and they borrow money. And then in the contract, there is a interest rate associated with that. And then they're allowed to recover that in rates. Straightforward. The other part of it is typically utilities, they have around 50-50 debt and equity. So that's for the 50% of debt. They just look at the interest rate. But for the equity, there is no interest rate or rate to that can just be observed. Like when you say, what's the cost of equity for any company, for Apple?
That's like stock, right? You're talking about stock,
like
right?
Stock. Equity stock is a form of equity.
Okay, right.
And so it's not directly observable. So you have to estimate it or calculate it. But there are very long-standing principles of finance that literally a first-year MBA, a first-year finance student, undergrad, will learn these methodologies and models. They're very simple. One of them you can calculate in your head. The other one, you need a spreadsheet, but it's literally just a few lines in the spreadsheet to calculate. So they're very straightforward models. There's each of them has a few assumptions, but there's not a great deal of sort of dispute about what reasonable assumptions are for these. So this idea that it's
unless you're an investor-owned utility, then there's quite a bit of dispute, I think.
Yeah, and not only that, they have their own bespoke, like they introduce models that are used nowhere else in finance.
Yes,
but they use them in rate cases.
Would it be fair to say, so the stock market kind of over the long term returns what, like 7% return on equity? I mean, it's 10%, but then you take out inflation and it's essentially like 6-7%, something like that, right?
So with inflation, there are virtually all the major financial institutions, JP Morgan, BlackRock, and so forth, they actually annually or more frequently, they say, this is our expected return on the market. And it's around 6 to 7% right there. And that's with inflation, not after inflation. With inflation, about 6 to 7%. You can go
And
look
what
at
is the
BlackRock's
return?
website right now.
That's important here because really what we're thinking about is, all right, that $1 billion that's going to go into building a transmission system or a nuclear power plant or whatever, I could as easily put that into some other, like I could put it into Apple stock or I could put it into whatever. And those are the like, so the idea is we need to achieve the sort of similar return, expected return on equity as putting it into some other investment vehicle, assuming like a relatively similar amount of risk, right?
Yeah. So importantly, of comparable risk. Right.
Right. Okay. So it's not Apple because Apple is more risky or,
Right.
but like something that's roughly similar.
But then what you saw in looking at the actual return on stock valuations of energy companies, of investor-owned utilities, it's much higher than 6.7%, right?
So so there's two different things. One is the authorized return, which in principle, right? So the authorized return on the equity, like the
Authorized return, you mean authorized by a public utility commission, right?
Yes. What
Okay.
they're essentially, so we talked before, the return on capital, there's a return
Yep.
of capital, the return on capital. So they're both collecting these in rates. They pass through the depreciation, they pass through the interest, they pass through the return on equity, which is determined by the regulator. And in principle, it should be, because it's cost of service regulation, in principle, the authorized return that the regulator allows the utility to recover in rates should be equal to the market-based cost of equity. In other words, what investors would demand, the return investors would demand on an investment elsewhere with comparable risk.
Right.
Yeah.
So,
but it's much higher, is what you're saying. What you're saying is for utilities is much higher.
So the market as a whole, like I said, you can go look at BlackRock or JP Morgan at 6 to 7%. Utilities do not dispute this, are lower risk than the market as a whole. So we would expect the authorized return, their cost of equity is lower than the market. You can debate, is it 1%, 2%, 2.5%, whatever, but it's definitely lower than 6 to 7%. But the authorized return is routinely on the order of 9 to 10%, sometimes 11%.
Right.
And it's been like that for decades.
So it's almost twice as much if you're talking, wow. Okay, so I said wow, but it was half-hearted because I knew I had read the paper, like written about it. So wow, oh my gosh, right? But like that is a big deal, right? Even though my head is saying wow, but my heart is saying because we know that.
Yeah.
But I guess one question is, how excessive is this amount, right? For a normal person, how much more are you really paying because of this excessive, nerdy thing that we've been talking about?
Yeah. So, there's different ways to calculate it. So, one analysis in the paper, I say it's about $50 billion a year nationwide.
Okay.
That's 10 to 12% of the average bill. This is the excess profit, not the profit that they earn, the excess amount.
Right.
You can also look at it in terms of the valuation implied in utility stock prices, and that's $1 trillion. So $1 trillion is sort of what the market expects utility regulators to continue authorizing excess ROE sort of indefinitely.
So the electric utility and gas, I guess electric and gas, or just electric?
Electric and gas. This is
electric and gas. So they are worth $1 trillion more than they would be if they were given a more reasonable rate. So this is a transfer of wealth from us. See, that felt more authentic.
That was a real wow one, I think, because I don't read reports in advance. It was a real wow.
That's a huge. So there's this big transfer of wealth.
Yeah.
How much is it per household?
$250 to $300 per household, roughly.
It's significant. It's
a year.
Okay.
And you say that this does other things because there are many things that utilities can do with their money, but they're probably incentivized to do the thing that's going to get them the highest rate of return.
Yeah.
And so you talk about capital bias in the paper. Yeah. So I mean, talk about how this sort of calculation, what you call financial alchemy, biases us towards a certain type of activity by utilities over other utilities that they could be engaged in.
Yeah. So essentially, because these rates of return are so much higher, right? Basically, for every dollar that they invest, so if they invested a dollar and it was just earning their cost of equity, then in their share price, it would just be worth a dollar. But
Right.
because they're earning more than their cost of equity, every dollar that they invest is a multiple of that. And it's a function of, technically, it's a function of the difference between the ROE and the cost of equity. So it's like levered. So currently, at current stock market valuations and authorized rates of return and sort of the implied cost of equity, for every dollar of equity, shareholder equity that they invest, turns into $2.2
Hmm.
in their share price or their stock market value. So I say, like, if somebody came to you and said, hey, if you give me a dollar, I'll put 2 or 2.2 into your retirement account. I say I can predict the next two things that would come out of your mouth. The first one would be, yes, I'd like to accept that offer. And the second would be, am I limited to a dollar? Can I do $2? Can I do $10? Can I do $1,000,000? And essentially, that's the deal that utilities have. And so they're just normal human beings. Like, they're going to keep investing until somebody says no. And, different regulators have different thresholds for saying no. I live in California, and their threshold for saying no is very, very high. Other states, say no earlier.
So, okay, so we'll get into how these utilities overinvest. Um, what, who does the ROE calculations, right? So it's not, it's not the CEOs of these utilities. There's a certain group of economic experts who go to these uh, commissions and they make an argument for this particular calculation. Who is that?
Yeah, so you almost universally they hire outside experts, and it's interesting. I did an analysis because I read a lot of these things, and I noticed, like, you see the same firms and the same names show up
Right.
over and over again. So I actually did I took a snapshot in time, and I looked at, there's a database that you can from S&P, and you can look at all the pending rate cases. And so I did a survey, like, who are all the experts? This is in November of 23. And I was shocked. It was basically all the utilities basically use four firms. And then there's one additional expert who is like the godfather of all these people, and he's retiring, so he doesn't do a lot of work anymore. But 90% used four firms. And then within those four firms, two people did over 50% of the ROE testimony for all these. I think there were 63 total utilities in this sample, covering, most of the major utilities and investor-owned utilities in the United States.
And
So
then
two
this,
people, two people basically run utility policy in America, is what you're saying. Two
Yeah,
experts.
and then when you look, the people from the same firm, they have very similar playbooks. Like, so, you look at there's about 8 different kind of models and techniques that they use, and then available in the toolkit, and then each one will use 4 to 6 of them, and so they just mix and match.
right.
Very, very
And
common. They're all
I,
singing from the same hymnal.
I want to talk about the model, but the absolutely amazing part of this is that they have their own society. So
Yes.
there's this certification organization that they're part of, and it has like this royal title, like the Society of Utility Regulatory Financial Analysts. Are
Yes.
they knighted that way? I don't know. But that's incredible that, yeah, there's like this set of secret people that are running this thing.
Yeah. So it's interesting. The SURFA, Society of Utility Regulatory Financial Analysts, they go by SURFA. So they don't train the utility experts. They train the intervener experts and the experts who testify on behalf of the regulatory
Yes,
and the consumer advocates.
that's the amazing thing. They're on both sides. They're the
Yes.
ones that are the experts that
Wait,
are serving for the
wait. So wait,
firm.
they trained the good guys too. They train the like consumer advocates.
No, that's their
Yeah.
primary responsibility, is to train the good guys.
Oh my gosh. So the people who are supposed to advocate for consumers are trained to advocate for utilities without knowing it.
Yes. And in fact, SURFA runs a training program at the NARUC, the National Association of Regulatory Utility Commissioners, the,
Right.
the
I mean,
regulatory body.
It's
I,
That's where they
I,
run the training program.
Well, I'm like it's like we're corruption sommeliers. Like that is it's like, oh.
And okay, so the other part of this is that you mentioned these models, right? And in the paper, you talk about four different models, and you say there are two of these that are not used anywhere else in finance to any degree. Like, talk about how these models are like almost bespoke, as you say. They're just
Yeah.
designed to screw ratepayers, basically.
Yeah. So the two models basically, so the whole idea is the rate of return, the return on equity should be equal to the market-based cost of equity, right?
Right.
So you would, in principle, okay, I look to the market. These two models are based on looking either directly or indirectly at the authorized returns that other commissions have authorized. So it's
Right.
only if the regulator is doing their job is it a proxy for the market, but it is on its face not the market.
So the Society of We're Taking Your Electric Bill Money has models. The models of the society are this is how the model is based on how much money we usually get and extract from you, and how much we're going to get and extract
Yes.
from you in the
It,
future.
it is the emperor's new clothes, like parable right there. I mean
Well,
so so
can I continue with this? Because there's a great
Please.
story here.
please
So
do.
the FERC, the federal regulator, did this whole rate of return sort of let's revisit our process, in the early
Mm-hmm.
20, about in the last 3 or 4 years.
Mm-hmm.
And they said, those two models, the one's called the risk premium model, the other one's called the expected earnings analysis. Those defy general financial logic because they said they're circular. They don't estimate a cost of equity. They estimate, right? They estimate
This
they're
is
just
the
telling you whatever.
Federal Energy Regulatory Commission
Yes.
saying the thing that is used primarily to determine electricity rates defies general financial logic.
Yes. So here's the thing, and they said, you can use these two other models, and the two other models are basically the ones that are taught in first year finance, called the CAPM and the discounted cash flow, CAPM
Right.
and DCF. Those are the ones you can use. And then they said, and here's how we recommend you implement them. And they said the risk premium and the expected earnings, they're defy general financial logic, and they produce systematically upwardly biased results. And they said, okay, these other models, you can continue implementing them, but how you implement them produces the same results as the systematically upwardly biased results.
Right.
Never connected the dots. And I literally just an hour ago got off the phone with a FERC lawyer who was involved in that proceeding. And I said that to him. I said, nobody connected the dots. And he's like, oh, nobody ever put that together. This is a lawyer for the FERC on that proceeding. How do you explain that?
I feel like the Society for grabbing as much electricity money as we can has figured that out. They looked into it.
Yeah, so it is
It's funny. So I had a conversation so I wrote a piece based on your report, which I thought was great. And since I steal all my ideas, I stole yours. And I got one of the consumer advocates wrote back, and we got into a conversation, and he was like, look at all this bad stuff that the utilities are doing. And I was like, then I looked at his ROE that his group put forward, and it was like 9.5% or something. And I asked him, I said, why? It doesn't sound like the utilities are the problem here or the only problem. You're the problem. Like, you put a very high ROE in there. You asked for really rates that were too high. Why? And I was nicer about it than when I'm, saying, I was, and he responded, he's very honest. He was like, yeah, I know, but we can't find an expert who will we're afraid of being out of the consensus, and we can't find an expert who will give a more reasonable, calculation. And I thought that was really interesting because it's, we talk in a other podcast, we've talked about norms, right? And this isn't the law is not bad here. The law is fine. This is just kind of like vibes-based rate making, right?
Yeah.
And his answer essentially was, I know this is wrong, but that's what the vibes are.
Right.
Yeah. The FERC lawyer said the exact same thing. He said, oh, they just put a finger in the air. And I'm like, they're making decisions that cost customers billions of dollars a year by putting a finger in the air. Like, I was just like, the
And
rationale that these, whether it's a regulator or consumer advocate gives, well, we can never go into a proceeding with a number that low because we'd lose credibility. Like, I mean, just these absurd,
that's the
they
amazing
make no
thing.
sense.
Like everyone has to be part of this herd that is giving the wrong information. And if somebody steps outside the herd and gives
Right.
accurate information, I'd be like, oh, I don't know what to do about this.
Yeah.
Well, they'll just throw it out. I mean, that's
yeah,
in the rate docket I looked at. They said, well, we throw out the high and the low estimates
right.
because we want to, and it's sort of like,
Yeah.
wait, what if it's correct?
What if it's the right estimate? Yeah,
right.
exactly.
But let's go into the other. We've talked a lot about how consumers are getting harmed, but there is this overinvestment problem. And I want to talk a little bit about that because one of the things that I think we've seen is utilities, their infrastructure is often ancient. They don't take care of the infrastructure. They're constantly setting California on fire. And like it doesn't seem like they're doing a lot of investing. And it also is very, now everyone's saying, when I say everyone, I mean, CNBC, they're like, we have to totally upgrade the electrical grid because AI is going to change the world, and Clippy, we need more Clippy.
But
Is that like, sorry.
I was just going to say, even without them, there's an energy transition going
right,
on. There are things that need to be connected to the grid.
So your argument is, well, they're over investing so that they can get, higher rates, so they can pay off those investments, right? But then most people are saying, well, they're not putting enough into the grid, right? How do you reconcile that?
That's a good question, and it's going to vary by state, right? So, I think, they will invest as much as they're allowed to invest, and then also in the things that the regulator wants them to invest in. So I think it's not controversial to say that the regulators probably underemphasized wildfire safety investment and maybe overemphasized EV charging or connecting distributed resources or things like that. So they're investing in those things and not the things that maybe if you were to step back and like what's really best for society, that's what we should be investing in. So I think there's an element of that. To be honest, I said there's two things regulators do. They approve how much the utility can spend and then how much profit they make. How much they can spend is really complicated. How much profit they make is really simple. I'm focusing on the simple part.
Well, so we don't have an answer here, but I mean, I could imagine a couple of scenarios. I've seen a lot of articles that say that, utilities in the US pay 30 to 40 to 50% more than utilities in other countries to build the same transmission lines or power sources or whatever. And one of the things that your paper implies is that they want to overpay because if they overpay, they make more money.
They're incentivized for getting it back. Yeah.
Right. Yeah. And there are different ways to incentivize these utilities, but I don't want to just say, oh, consumers are getting harmed because I am a heartless, evil person. And I like that. I get off on that. But there are practical problems aside from that, which is that the actual utility grid is not functioning very well, even though you have this overinvestment. Anyway, that's just an observation.
But I want to ask about these public utility commissions because you mentioned that they're using some of the same people in the society. They're basically dealing with the same assumptions, same models, and everything. Is this because you could look at it one way as it being about capture, that they just have the sort of same mindset as the utilities themselves. You could call it a story of money in politics. If they're elected public utility commissioners, maybe electricity companies are their donors. Or you could call it more just a fear of stepping outside the box. So, I mean, I'm wondering where you see it. Is this corruption or is this just fear?
So technically capture is corruption. Like when
Sure.
they say capture is a form of corruption, it's just not the bribery kind, but it is a form of corruption because it's a dereliction of their regulatory, their regulatory authority. I don't think these people are like out like they're bad people. I just think that the incentive structure is wrong, right? And also I think people are cognitively lazy. So this, this Maryland person that Matt spoke with, I have, I have submitted proposals to them to try to help them ROE, and they don't want my help. I have made presentations to their organization, the NASUCA, National Association of State Utility Consumer Advocates, laying all this stuff out in the paper, and nobody follows up with me. Like they are comfortable with the status quo. I think there's just this is maybe a harsh thing to say, but I don't think, our state commissions are necessarily attracting the highest caliber people and giving them the right incentives to actually do their job the way it's supposed to be done.
They're also outgunned, right?
well,
I mean, they don't have the same amount of money as an investor in utility does.
They don't, but they, for example, they don't prioritize well. So,
Right.
I'm like, they're saying like, look, if you were to focus on rate of return, that's $1 billion a year savings in your state.
Right.
It's like, you should really focus on that. And they're like, no, we've got this, $100,000 line item. We're going to focus on that. And that's just playing the utilities love that. Right?
I've never thought that advocates do anything but engage in perfect strategies. I mean, I'm an advocate, myself. So the misprioritization is there's a lot of reasons for it, and I'm more sympathetic, because it is hard to, you have multiple stakeholders. Politics is its own thing, right? And being skilled at, that $100,000 whatever might be very important to the stakeholder who keeps you able to do the advocacy on this other thing, right? So it's not necessarily fair to say that they are not interested, or, I mean, so obviously, like, I'm an impatient and angry person, so I generally agree with your analysis, but like the fact that it is system-wide suggests there is something else going on. But what I want to just like mention, like, Connecticut regulator Marissa, is it Gillette? I think it's Marissa Gillette is how to pronounce. I've just read her name, but she's like someone I admire because, she actually hasn't done the thing that you've asked, which is to really cut the ROEs. But she has fought the utilities and actually reduced rates in certain cases and reduced increases. And she's getting sued, right? And they're doing extremely dirty, nasty things to her politically because she did step out. Yeah. And I think they have ways of doing that to you, right? So the fear is reasonable, or the desire to stay within the consensus is reasonable. Like, you don't step out in necessarily. So I just wanted to mention that because I don't think it's an insolvable problem. I just think it's a difficult one. But
I mean, Mark, you actually give some solutions to the problem in the paper. You've made a few recommendations here, and the biggest one being, kind of throw out these models, look at financial reality, right? I mean, talk about the sort of recommendations that you put forward in this paper.
Yeah. So the first one is, just codify it. So this rate of return equals cost of capital. It's a long-standing sort of legal precedent from the Supreme Court, but it's actually not in legislation anywhere. So just put it in law, right? So that nobody can, wiggle out of that. And then I think as you put it in law, like, codify how to do it. So it shouldn't just be this free for all and let utilities introduce these crazy models. Like, specify these are the models that are acceptable. These are the assumptions or data sources that are acceptable.
Right.
And put it in the hands of the regulator. Because it's literally, you could write a script, right, or a VBA code for an Excel model and push a button and it generates it. And I can tell you that's what the utility experts do. They have an automated model that generates it for them. You could do that, put that in the regulator, and then the utility can appeal. But it's the regulator decides what the cost of capital is, what the rate of return cost of capital is, and sets the rate of return equal to that. So take it out of the hands, get rid of these dueling experts, and just put it in the hands of the regulator. So codify it, put it in the hands of the regulator. I have a number of recommendations about how the intervener and advocacy community can do a lot better. That community, like Matt said, they have a lot of competing interests, right? Rooftop solar may have a different interest than low income, may have a different interest than large consumer. Everybody wants lower rates. So they shouldn't,
Right.
I'll go into a proceeding in California and there's 6 different parties putting in testimony on ROE. And I can tell you, like, EDF doesn't disagree with, some other, the oil and gas producers because, they have a strong view on the beta to use in the CAPM. It's just, we just always use different experts, right? We just do this independently. Well, that's
Right.
just silly, right? It just makes the regulators' job harder, which they don't like, and it makes the utilities' job easier, which of course they like. So there's opportunity for them to collaborate on this one issue more than any other issue going on, and they don't. And so I think there's a huge opportunity there. I'm also just being more strategic. Like most of them, because they're experts, are these surfer trained, right? Who are just parroting. They don't realize how much value is at stake here. And I think they need to get smarter on that and realize, like, no, this is actually moves the needle. And one of my friends who's involved in this space, he says, rate of return is the skeleton key for everything you want to do on utility reform and utility accountability. And
Right.
I agree. So I think
It's
there's
really
an
good.
opportunity just for them to be more strategic and also to collaborate. And then I have another, go ahead, Dave.
Well, you had this side note
Yeah.
that I thought was incredible that I did not know that lobbying expenses are something that utilities can recoup by passing through to rates.
In
So
some states.
the
Yeah.
customers in some states, the customers are paying for the people who are trying to jack their rates up.
Mhm.
It's unbelievable, and
Yeah.
that's something we could get rid of pretty
Yeah.
quickly.
Yeah.
Yeah, well, we've actually worked on that. We've done polling on it. That's very unpopular. People do not like that, which is
What?
surprising. I love that we have to do polling on something so obviously
All
bad. But
right.
like, yeah, in some states
Corrupt.
they're not allowed to do that.
Yeah.
Okay, so I've got a question, 2 questions on private equity, and
Okay.
surprisingly, one of them is about private equity as the possible good guys solutions here. But
Yeah. Yeah.
I'm not going to start with that one because I'm allergic to it. But
Oh.
I will. So I'll start with them as the bad guys. I'll start the other way around. Okay, so you've recently testified on private equity in the utility space. Now I read your complaint, or not complaint, but your testimony, part of it, because a lot of it, the good parts were redacted. Top line, what did you find?
So there are not a lot of M&A transactions in utilities because once a utility has that business, like it's just
Right.
it's a pocket picking machine, right? It's a customer pocket picking machine.
You don't have to
They
go
hang
from
on to
one to
it,
one.
right?
Usually you merge to reduce the number of competitors in a
Yeah.
market. This is already reduced.
When it's utility is actually not very concentrated because everybody's hoarding what they have. Like it's
Right.
such
It's
a good
regionally
thing.
concentrated,
It's
but
just
not
it's a
nationally.
machine where you put $1 in and you get $2
Two
out,
back,
right?
Yeah.
right?
Why would
Right.
you sell that?
Why would you sell that? Exactly, unless you
Great
have to.
business.
So in any event, there is a utility that's up for sale. It's called Elite, and it's the parent of Minnesota Power, and it's being bought by 2 parties, GI Global Infrastructure Partners, which through the course of this acquisition was acquired by BlackRock, and then CPP. It's a Canadian. It's affiliated with a Canadian CPP is affiliated with a Canadian pension fund. So
Right.
they're buying Elite, and the Elite is basically it's Minnesota Power and then a few other businesses, but Minnesota Power is the bulk. It's like the crown jewel, and it's the main thing that when you're buying Elite, you're buying Minnesota Power. And what I was particularly interested in testifying in this case because transactions sort of make it undeniable sort of what this rent seeking that's going on. Because, basically in my testimony, I say, hey, Minnesota Power has a rate base of 3 billion, half equity, half debt, so 1.5 billion of equity. That's their actual investor, how much they have invested. But when you read through all the public documents about the valuation of GIP, CPP, how much they're paying, they're saying, well, we're valuing it at 3 billion. So again, it's this 2-to-1, right? They're valuing it. And so you think to yourself, well, wait, what's going on here? First is what did Elite shareholders do to deserve this 1.5 billion? They have a 1.5 billion invested. They're going to get 3 billion. So they get a $1.5 billion windfall. What do they do to earn it? And you think to yourself, well, it's not anything they did in the past because that ROE was already compensation for their investing in the past. It's not anything they're doing in the future because they're selling. They're not doing anything in the future. So all it is, it's just a reflection of sort of they have this pocket picking machine, and GIP is saying, I'm willing to pay you $1.5 billion, twice what you paid to step into your shoes. Now think about that. So to earn their money, right, they have to, earn not just the 1.5, but the 3. So they have to for them to make a return on their investment, they have to grow this thing even faster. So it just shines a spotlight like, hey, the ROE, the only reason why GIP CPP would be willing to pay that is because the ROE is so much higher than the cost of capital. That's the only reason. And it's a completely unearned windfall. Elite shareholders have done nothing to earn this. So that was very interesting, just to sort of like shine a spot like that. It's like staring you in the face. Like you could say, oh, the price to book, that's market, blah, blah, blah. We don't really know, and there's other businesses and there's leverage. There's all these other things that can complicate it. This is just staring you in the face like they're paying this huge windfall. It's undeniable. Yeah.
So it's just a bet on corruption, right? We can get this.
Yes.
We can get them to keep,
yeah.
right.
So, yeah.
Okay. So I guess let me do the good guy private equity question. Okay.
Yeah.
Or good guy investor question. So there's a typical kind of left-wing view that utilities should just be owned by the state, right? Or through co-ops or some other, municipalities. And there's a case for that, right? We have a lot of publicly owned co-op or publicly owned utilities, and they generally don't overinvest. They're generally, the prices haven't increased nearly as dramatically, and so on and so forth. But you have actually identified a different way to address the problem. And I'm reading a little bit more than your paper, but it's just based on our conversations, which is to actually bring in large investors to put money directly into the underlying assets, right? So not going through the utility company itself, but to say, I want that guaranteed return on equity myself, and I'm willing to enter in and pay for it, and kind of run an auction or something. I'd love a 7% guaranteed return. I'm sure, I don't have an infrastructure team working for me to figure out how to do that, but I'm sure that there are, private equity guys or people in infrastructure shops, or just, Wall Street has a lot of people in it that would love that guaranteed return.
Yep.
Is this viable? How would this new financing model work? It seems like a win-win, but
Yeah, so I'll step back. So there's a long-standing regulatory principle. Regulation is a surrogate for competition. So implicit in that is where you can have competition, you should. And that's a very common thing in regulation. So, California's RPS, Renewable Portfolio Standard, basically the utilities were prohibited from building the plants, new power plants. They had to go to the market and have competing bidders build the plant. So this idea of like, hey, utilities should use competition where they can, that's a long-standing regulatory principle. So the idea is, if you look at the utility model, it's like, oh, you're a natural monopoly for operating, and they bolted onto that a monopoly for financing, but only the equity. For the debt, they go to market. They're just saying, oh, I'm just going to go to my parent and they're charging me 6% and I'm going to pay. No, it's like you go to the market and either you issue bonds or you have competing banks and, you use market forces to get you the best rate on the debt. And on the equity of this weird thing, it's like, no, it's just this negotiation between you and the regulator and, some unwitting sort of collaborators, right, in this whole process. And that's just, maybe there was a justification that back in Edison's day where like capital markets were not as sophisticated and we didn't, and it was hard to raise large amounts of capital. But for today, like we can slice and dice, the capital structure in an infinite number of ways. So that was really the motivation is like, well, why do they have this monopoly? It's just, they should go to market. And the basic idea is when you look at that GIP sale of Minnesota Power, essentially what's going on is they're saying, hey, the regulator is giving me, 9.5, 10% ROE, this cash flow into the future. And it's going and it went like, how much are you willing to pay me for this? And so the market bids up, right? And so GIP CPP said, I'll pay you $3 billion, right? Oh, okay, let's do it. This would be the reverse. It would work more like the bond market, where the bond market says, I need to raise $1 billion. What rate will you offer me? Right? That's how the bond market
Hmm.
This is basically doing that, right? So it's saying like when instead of elite doing what they did, they say, hey, I need to raise, their whole premise is we need to raise capital, but our other, we need to raise capital, but we're capital constrained. And that's a whole other discussion, but let's just assume it's correct. They need to raise capital. So go and say, what are you going to charge me? As opposed to what are you willing to pay? That's
Right.
the basic idea.
Hmm.
And so then you think, well, okay, makes sense, but who's going to invest in this? It's, it's actually a little bit more complicated. So I kind of went through different criteria, and it was a natural, like you'd think, oh, long-term yield-seeking investors would be very interested in this. Somebody who's like, oh, I need to invest and I need something that produces a lot of income or like a
Long-term
steady income.
stable returns.
Yeah.
Yeah.
So it turns out that there's a lot of investors who want that. And in
Hmm.
particular, people who are investing on behalf of retirement funds are very interested in this. Pension plans,
Right.
and then others who offer not just state pension plans, but retirement products for regular consumers. They have huge, trillions of dollars of assets that they're investing, and they want something like this. And they are typically, they say we're capital long deal constrained. Like, they're relegated, like, oh, we can invest in bonds, but there's nothing else out there that sort of provides a steady return. And you think, well, why don't you invest in utility stocks? But the stocks don't return that nice steady cash flow because one, they're traded on the market, so they're constantly fluctuating, like they're
Hmm.
the
Hmm.
dividend plus capital gain. And also when they get the money from the utility, they don't distribute it to their shareholders. They reinvest it in other businesses, or they say, oh, I'm going to save it for potential future growth. And what all of that does is it creates a lot of uncertainty in the value of the stock and the yield of the stock over time. So you have this weird thing where you have this nice, stable, very attractive business, and then you have this parent company overlay, the public market overlay, that like introduces all this noise and uncertainty that makes it less attractive.
Right.
And so the idea is like, hey, these entities, they're they're not participating in the public market. It's a private market transaction that just want that long-term steady yield. And so create a
Okay.
market for that. That's the basic
Great.
idea.
Yeah. Um, this is a lot of this episode is what I would call a breaking plates episode, that people will be listening to this and just breaking plates. There's just all this anger and frustration around the issue. But I think what it shows is there's this power in just explaining the basic facts. And that's, I think, what your paper does. It just explains there's a financial reality here, and there's a set of rules that are being played by that are completely at odds with that reality. And I'm wondering if you think just having that knowledge is enough power itself to maybe shame the nerds into changing this system.
Um, I don't think shame is enough. They're pretty shameless already.
Okay,
I'll give you
given,
an example.
granted.
I mentioned NARIC before, right? So NARIC, they have an annual meeting, and you can go on their annual meeting and like, who are the sponsors?
Hmm.
Who is the lead sponsor for the NARIC annual meeting? The Edison Electric Institute, the
Right,
Utilities Trade Group. I
right,
mean, that I don't know how you can get more shameless than that, right? Where
right.
you're
But
like
it's
the
just about getting that information out to a lot more people, and
yeah. So,
uh,
I think though that there's just so much the utilities, when you think about utility reform, it's like consumer groups, sometimes consumer environmental versus utilities in Wall Street. And like
right,
that's just a non-starter. And you can shame them all you want. I don't think you'd and I think in utilities and electric utilities in particular, the utilities have co-opted the environmental movement, but that's a discussion for another story. Like they basically have convinced them that no, they need the ROE, the high ROEs for the energy transition.
right.
So environmental groups are not big advocates on like they don't make a big stink about typically don't make a big stink about ROE. They don't care too much.
Mhm.
Um, so I think though, if you can peel off some of the investor community, people who, oh, I can make money by going
The
on the
finance
political
guys, yeah,
side of the utilities, that I think
right.
is,
There you go.
No, I enjoyed this. Thank you so much, Mark. And I sense a deep rage underneath the very nerdy exterior. And I respect that
Underneath me.
tremendously. Yeah.
So yeah, I just find this. I have this thing about abuse of power, and it's just people
It's
who
a
have
quirk. It's just a
but
thing you have. Yeah.
yeah, people who are in positions of authority, like they're entrusted with responsibility, and when they say it's like, no, this is my privilege, I just think like you undermine so much in society. Like it's just
Yeah.
and particularly like I've been working the utility industry. My very first job, I was a seasonal waterworks labor for LADWP. I was 18 years old. And I'm just like, these people, they kind of keep society running, and we don't even realize it. They're like down there keeping everything going. But then you have these people who are running it who are just like, yeah, this is my tool to just rip the public off.
A pocket picking machine,
Yeah,
which I
Yeah.
love that.
I just think that
There's our title. All
Well,
right.
listen, thanks for coming. We really appreciate it, and good luck. We're cheering for you, and I'll do what we can to help you.
Thank
Thanks a
you.
lot, Mark.
All right.
Thank you.
Well, so I've known Mark, I guess, 6 months or a year or so, and he approached me because he's interested in monopolies and competition, as you can tell, and he laid out this basically the story that he told us and said, here's what's going on. It's this small group of experts, the evil nerds, right, who run the world in my
Right.
his corner of the world. And I thought this is exactly like what happened with antitrust, where you had a small group of annoying experts who said, we don't have a monopoly problem. Everything is great. And hey, they had run antitrust into the ground since the 1980s. And I was like, this is the same thing.
And I'll extend it even more. They use fake models of the world that don't correspond to how things actually happen in order to do it. The fact that they're using these bespoke models that the national energy regulator literally called garbage, and yet they're still using them, is it's just an incredible story.
It is, and I think in some ways it is the story of modern America or the modern American economy, because you can find analogies to this in pretty much every sector, right? You work in antitrust and you see, because antitrust is across sectors, but you could go into healthcare and I'm sure you would find certain calculations for
Oh, yeah.
Medicare reimbursements or PBMs or whatever, and you'd find
Yeah.
similar nerds who are doing the consensus thing.
Upcoding, right? I mean, the fact that you take a customer code and make your patient look sicker so you can get more reimbursement. That the whole value-based care model right there is exactly an example of this, and it's hundreds of billions of dollars.
I mean, I was told about a spectrum auction that was organized by a Nobel Prize winning economist who was also kind of working for private equity firms that were like going into the auction, and meanwhile working for the organization, the FCC, that was structuring the auction. And it's like there's a small group of auction experts. And so it's like you go around, they also do energy stuff, like not in the utilities, but it's like you go around America, and what you will find, the reason you find something that's irrational, and often what you will find is there's a small group of credentialed, certified people who are like, don't touch our models. Our models are beautiful. And
Right.
it's screwing everything up.
Right. And I think there is value. I know Mark kind of downplayed it, but I think there is value in just lifting the curtain on
Yes.
on the evil nerds and just saying you're ridiculous. So well, that was great. Hope you enjoyed the episode. And next week, you're really going to enjoy it because we are going to bring on the former chair of the Federal Trade Commission, Lena Khan, to talk to us about all things antitrust. And it should be a great one. Don't want to miss it.
Organized money